In the world of investing, a company's earnings are invariably linked to its sector and the larger economy. Let us dive into an example. The sugar sector has been making heavy losses until a few years back, precisely when the government decided to bring in the rule of blending ethanol with petrol to curb the impact of oil volatility on the end consumer. The sugar companies jumped at this chance and started to produce ethanol from sugarcane. Can you guess what happened next? Companies started making profits and their stock prices moved up. Another prominent and most recent example of the sector includes the telecom sector, where the entry of Reliance Jio with all its free offers displaced the existing players in the telecom industry. Several companies also went out of businesses and some got acquired and got consolidated with the bigger player. Post this shakeup, the sector is left with only 3 key players, of which only 2 companies rule the roost. With the economics of the industry now favorable, companies have started becoming profitable again and the sector has turned around. The economy is just as important to track. Several indicators such as GDP, IIP and inflation can directly impact company earnings. For instance, a rise in inflation drives up the prices of raw materials, which leads to margin pressure for companies where the commodity is the key ingredient of its production cost. It affects both the company earnings and its stock price. This should not be treated as a recommendation. Please conduct your own analysis or consult a financial advisor before investing.